Good evening, everyone. Welcome to um Edelweiss Connect call. This time around, we have decided to talk about Edelweiss Small Cap Fund in detail. The fund has completed more than 4.5 years since its inception in January 2019 and has done wonderfully well. Um, the markets have been buzzing in last 3 to 6 months, and there have been a lot of questions, especially with regards to small cap funds and small caps in general. So we thought that what better time than now to get Sahil Shah, who's our fund manager for the Edelweiss Small Cap Fund, to come on a call and talk to you about his take on the small cap fund. Post which we will open the show for further Q&A. Over to you, Sahil.
Thank you, Deepak. Thank you so much. So basically, I'll divide my presentation into two parts. One is on why small cap as a category now, and second on I'll talk about the Edelweiss small cap fund. So first, talking about why small caps. So I truly believe that returns are a function of two things, which is your starting valuations, where are they in terms of the cycle, and the second thing is the earnings growth. I think as far as small caps are concerned, we are not in the euphoric zone that we have seen in 2007 and 2017. So what we saw at that point of time was that Nifty 50 or the broader indices itself were trading at around 25, 27 odd times. And on top of that, small caps used to trade at around 20 to 30% premium, almost at around 30, 32 times. With the benefit of hindsight, we know that the years after that, the returns in the small cap were very, very subpar, or at least they have relatively underperformed the large caps. But this time around, as you can see, the valuation multiples of small cap are reasonable. We are not saying that they are at the bottom of the cycle, but we are seeing that this is at the mid of the cycle or at a long-term average. When I compare these numbers with the large cap premium discount of small caps, we are not seeing the premium that we were seeing at the peak of the cycle of 2017 or even in 2007. We are, in terms of valuation multiples, they are slightly below the large cap multiples, when itself the large cap multiples are trading at around 18, 19 times and not at 25, 27 odd times. This gives us comfort in terms of where the starting valuation multiples are in the small cap space. The second important point here is the earnings growth. In the earnings growth, as you can see, for a long period of time, whether it was Nifty 50 or whether it was small cap 100, the earnings growth had gone nowhere for a very long period of time. It was post-COVID that earnings growth has significantly picked up. In fact, over next 2 years, we are expecting a healthy 20% plus earnings growth in the small cap space. Now, when I compare this earnings growth with what is projected for Nifty 50 over next 2 years, this is almost 5% to 6% higher on an annualized basis as compared to the Nifty 50 earnings growth. This makes us believe that when the starting point in terms of valuation are not rich or are not in the euphoric zone, while the growth is expected to be higher, we expect that the small caps to relatively outperform large caps from here on, at least over next 2 to 3 years. While it is very, very evident that over last 5 years or even over last 10, 15 years, small caps have outperformed large caps, at least at the fund level. So going by the history, going into the future, we believe that the small cap should outperform large caps. Now, what is kind of driving this earnings growth is also important to kind of note. In large caps, almost 40% of the earnings is driven by global factors. What I mean by global factors is that either it is commodities, which are where the prices are globally linked, Um, or it is a conglomerate which has got a foreign subsidiary or a global subsidiary somewhere in Europe or US, from where the earnings are coming through, or through exports, right? So this portion, we expect that India in next 3 to 5 years should do materially better as compared to some of the developed economies. And hence, we see a lot of emerging themes, emerging opportunities, which are there in small caps and mid caps, which are absent in large caps. So one is the number of or the quantum of earnings growth, but there is also an underlying theme which is playing out, which is supporting this earnings growth. Now, what are those themes? So I'll talk about some of the themes that we are kind of having it in our portfolio. So some of the investment themes that we have in our portfolio, and one of the themes that we like is the building materials theme. Now, when I talk about small cap, there are a lot of emerging opportunities which are there in small caps, whether it is movement from unorganized sector to organized sector, whether it is playing the penetration story in India, where a lot of things like, for example, air conditioners are highly underpenetrated in India, and players like Daikin, who are unlisted and who don't have a vested interest to kind of drive their share prices, have also talked about a very healthy growth in air conditioners. And so is the case with washing machine. So this underpenetrated opportunities are available in the small and mid cap space, which where you find very limited options in the large cap space. For example, QSR, the quick service restaurant, the likes of Domino's, McDonald's, or a Burger King, this opportunity is available in the small mid cap space and not in the large cap space. So this makes us believe that, or when we talk about China plus one, for example, right? So these are the opportunities which are available on the small cap side. So one of the themes that we like is the home building theme. When I look at the portfolio, we are significantly overweight on the home building theme. So what we have done is that we have taken home financiers, we have taken building material companies, we have taken real estate companies, and we have taken cement companies. If I do a sum total of them, we are almost 4 to 5 percentage points higher in terms of, or we have overweight stance in the home building material theme. The reason for that is that housing inventory, as you can see in the graph, was at almost 3 to 4 years. This has materially come down to almost around 1.5 years. Now the new launches are happening, and we are seeing it across, whether it is likes of DLF or Brigade or Prestige Soba, that the real estate sales has picked up materially. So this makes us believe that after a lull that we have seen in housing space over last 10 years, the housing cycle has come back. And the second derivative impact of that will be on the building material companies, whether it is a plywood manufacturer, whether it is a tile manufacturer or a pipe manufacturer. So we believe that this particular theme, which is home building, should do materially well over next 3 to 5 years. The second theme that we like is on the capital goods side, where we have seen that the players like ABB or Thermax and a lot of these capital good companies, after a long period of lull phase, have started getting good order book growth. And this order book growth has been upwards of 25-30%. A material order book growth has come through in this kind of companies, which gives us a lead indication in terms of how the private capex cycle is going to play out in India. So the supporting factors are that the corporate balance sheets have kind of delevered. Banks are ready to lend. Their NPA cycle is has already kind of ended, or it is almost near to the end. And on the other hand, the capacity utilization is at around 75% at an overall level. So this gives a this is what is driving the private capex, where we are seeing initial signs, at least over last 3 to 4 quarters, where the order book of such companies have gone up materially. So capital goods is another sector which we are quite overweight on. The third theme in the portfolio is basically China plus one. Now, what we mean by China plus one is basically um, what we have seen with the chemical companies, where there was a lot of shift that has happened from China to India, because a lot of manufacturing in chemicals shifted from China to India because China got stricter with their emission or pollution norms, which resulted into higher cost of production of Chinese chemicals, which kind of the inherent advantage the Chinese chemical companies had kind of went away. And that made India's chemical companies more competitive as compared to China. The other thing that is playing out is basically the geopolitics, which is going against China. So when we talk to experts, when we speak to the portfolio companies, they clearly tell us that the customers want to move away from China. And China being a dominant portion, even a 10% shift from in terms of outsourcing from China in the chemical space would almost mean doubling of the overall chemical industry in India. So that is the size that the shift in China can offer, and that is what we have been seeing over the last 3 to 5 years. A similar theme is now playing out in the EMS space, which is your electronic manufacturing services space. Now, as we go through the government's vision document of EMS or their electronic manufacturing that they want to do in India, the current electronic manufacturing that is done in India is around $70 to $80 billion. This can go to almost $300 billion. Now, this is a vision document, and obviously, I mean, this is not going to achieve in the timelines that government has said, which is around 4 to 5 years. We are talking about tens of billions of dollars of industry kind of tripling and quadrupling in a matter of 3 to 4 years. But even if a part of that is achieved, that would mean a big growth for companies in the electronic manufacturing service space. There are companies which have got recently listed. There are companies which have been there around in the listed space over the last 3 to 4 years where we are invested in. So these are the themes that we like in the portfolio. Finally, when I look at the portfolio, so basically, I think what we don't do or how we manage the portfolio is very, very important. So the process that we follow is basically the FAIR framework, where F stands for forensics, A for acceptable price, I for ESG informed, and R for robustness of business. I think amongst this, the first filter is that of forensics or accounting quality checks, which is the most critical filter as far as small caps are concerned. And here we do a lot of things whereby we not only do the desk research, but we also kind of go and visit the plants to kind of see where the capex has been done, how it has been done, what are the capacities, and so on and so forth. So I think this helps us to kind of filter out stocks and allows us to make an investment universe from which we can choose stocks. What is also important is what we don't do, right? So here we don't first of all take any outsized sectoral bets, meaning we will never be away or out of any major sector. We will be underweight, but we will never be out of that particular major sector. Neither we will be overboard on a particular sector. So let's say we will never be like 10-15% overweight on a particular sector. And the reason is that in small caps, we are here not to take sectoral calls or big sectoral calls, but rather do a bottom-up stock selection and make outperformance or money through selection effect rather than allocation effect. And as I said, we don't want to make money through allocation. We also don't take any macro calls, and subsequently, we don't take any cash calls. We are style agnostic as far as whether it is value, growth, or GARP, whatever one can call it. And that allows us to kind of have more consistent performance over a period of time, rather than being Q1 in a year and then followed by that Q4 in another year. So I think having a diversified portfolio, being sector agnostic, being style agnostic, not taking macro calls, allows us to be more consistent along with the process overall, which we call it as a fair framework. Finally, talking about the portfolio specs. So the portfolio earnings growth is expected to be at around 23, 24 odd percent over next 2 years, with a price to earnings multiple for the next year at around 20 odd times. And to get this growth, we are not compromising on quality of the business. If our return on equity is one measure to measure the quality of business, the portfolio return on equity is at around 17 to 18 odd percent, which is very much comparable to some of the large cap portfolios where the quality standards one would assume to be very, very high. The debt to equity of the portfolio is 0.2 times, which is almost negligible debt. A lot of companies in the portfolio are cash rich. So that makes us believe that a portfolio which has got companies with faster earnings growth, good businesses, have market leading qualities in the segments that they operate in, with the themes which are aligned, which can grow at a faster rate than the nominal GDP growth rate, should do better in the coming times. So with that, I'll come to the end of my presentation, and I'll just pass it on to Deepak on the range.
So Sahil, the most important question is with regards to timing. We have seen almost a 4.5-year period right from when we launched the fund. The fund has done extremely well. The space has done very well. And there are lots of doubts among people whether the time is good. Is it a possible case to think that there could be meaningful correction? So how should people go about allocating in small cap funds?
Yeah, sure. So I think, as I said at the start of the presentation, that the chances of losing money or underperforming over a medium term, that is, let's call medium term as next 1 or 2 years, is when the starting valuations are too high, which was the case in 2007 and 17. We are nowhere near that zone. In fact, in somewhere in October 21, when the markets peaked, the small cap valuations were at around 26, 27 odd times. And since then, since the market is almost flat, while the earnings has gone up by 25 odd percent, that makes that the price to earnings multiple of the valuation of small caps are at around more in a more palatable zone, which is at around 18 times. Which is very close to the long-term average. And hence, we believe that over next 2 to 3 years, the chances of underperforming in small cap is, I would say the probability that I would assign is on the much lower side, especially with the kind of strong earnings growth that is being projected on the small cap side. So I think while nobody can say what is going to happen over the next 3 to 6 months. And hence, whenever we suggest about investing in small caps, 3 to 6 month SIP is the best way to kind of start investing in the small caps.
So, Sahil, this is a question with regards to size. See, when small cap funds started entering market, the market cap size of those companies used to be 1,000 crore, 2,000 crore, 3,000 crore. Given a case of 20p, there were companies in the range of 100 crore, 150 crore profit. Today, the starting point of small cap is almost $2 billion. And it goes up down to a list which is very large. But what is your way of looking at small cap funds? And would you really call them small cap in the true sense? Because our country follows a rank-based definition of small cap. Does it really represent the true small cap in the real sense from a global perspective, or is it more mid cap, uh, which is you would like to ascribe?
So I think you are right that what was considered to be large cap 20 years back and a mid cap 10 years back, it is classified as small cap today in terms of the absolute market cap. And since we follow a rank-based approach towards classifying between large, mid, and small, uh, 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 companies typically starting from 2 to 3,000 crore market cap all the way to 18,000 crore are classified as small caps. Now, the general perception of small cap is that these are small companies, these are promoters who would have kind of got recently listed, or other businesses would have achieved scale very, very recently. But I think that's not true. There are a lot of companies. In fact, the hunting ground or the available size of companies, account of companies to be chosen from in the small cap space is much higher than any of the other caps. That is one. Second is that a lot of these companies have a good track record of last 5 years, 10 years, and even across last 2, 3 decades. So these companies are not companies, while they are classified small in size or small caps, these companies have long of history where they have got achieved market leading position in certain segments or sub-segments. So that's number one. Number two, I think because the mindset of the promoters have shifted in India over last, I would say at least decade or 15 years, the small cap companies do regular con calls, most of them, like what mid caps and large caps do. So in terms of disclosures, in terms of interactions, they are answerable on a quarterly basis. And I think that itself keeps them, or at least it keeps minority interest guarded in terms of any misdoing that one would expect in this small cap stock. Obviously, the risk is obviously higher as compared to a mid or large cap. But I think over a period of time, given the promoter's focus is now more on his net worth, market cap, rather than how much of his personal wealth he has kind of made, that mindset shift and the quarterly disclosures, the quarterly calls, a lot of changes from the regulator standpoint, where you need to have a majority in the minority to pass a certain resolution. I think those steps have kind of made the governance standards of the small cap companies have kind of gone up. So I would say that while these are classified as small caps, but there are a lot of good companies where they have market leading position, extremely good ROCs, certain companies which you will never find in mid caps or even large caps, which are there in small caps, and they are doing great.
So, Sahil, let me play a quiz game with you.
Yeah.
I will take the name of the company.
Hmm.
You have to tell me whether they are leaders or among the leaders. Yes or no?
Okay.
I mean, you can classify them whether they are leaders or among the leaders also.
Sure.
So, Dr. Lal Path Lab,
yes, they are leaders.
leader or among the leader?
Yeah, among the leaders.
Okay. Exide Industries,
Yeah, a leader.
India Mart,
Yeah, among the leaders.
Blue Dart,
Again, it's a leader.
Gillette,
Leader, complete leader.
let me ask Blue Star.
Among the leaders.
Okay. East India Hotels,
Among the leaders.
Century Ply,
Clearly a leader.
Kalyan Jewelers,
Among the leaders in a crowded market, I would say.
PVR Inox.
Leader, duopoly market.
So I have only mentioned some of the names in the small cap space, and these names I've just randomly picked looking at the Amphi website. and most of these companies have a market cap, closer to 1.5 to $2 billion. So, I mean, just wanted to emphasize the point that you have made, that many of these small cap companies are not exactly small. So, small doesn't necessarily mean inferior, correct?
Absolutely, absolutely.
So,
I
within
mean,
the small cap space, which are the sectors which look promising at this point in time?
so I think one of the subsegments that we like, so as I said, capital goods is something that we are quite overweight on. Home building or the home building space is what we are quite optimistic on. China plus one theme, whether it is chemicals or electronic manufacturing services, is something that we are bullish on. I think within the consumer discretionary space, auto components, the companies are trading at reasonable valuations and expected to grow their earnings at a very, very good pace, as we are seeing that the car bookings are still strong in India. And one of the other consumer discretionary space that we like is quick service restaurant space, where companies, some of the companies, they are part of our portfolio. So I think quick service restaurant space in India, I think it is at a very nascent stage. When I look at Domino's, for example, over last 10 to 15 years, they have grown their network as well as their sales by almost 10 to 12x, right? So that clearly tells you that it is at a very, very nascent stage. They are hardly present across 2 to 300 cities, whereby they have scope to go to 900 odd cities in India. The overall industry size, the outside eating market in India is around 4 lakh crores. Out of that, this QSR companies is around 80,000 odd crores. So, and when we are talking about some of the leaders in this space, they are hardly 5,000, 2,000 odd crores in terms of revenues. So I think as they kind of expand into different cities, and as Indians are now used to or have developed their taste for pizzas and burgers, I think these companies have a lot of room for expansion in the country, and they can grow at a very, very fast rate over a very long period of time. I think QSR as a space, it is a very easy business to enter into. We see a lot of local companies or local food chains emerging, but it is a very difficult business to stay and execute, especially across at a pan-India level. There are very few pan-India brands in India which are able to kind of scale it up. So some of the listed companies offers that opportunity to kind of play this theme.
So, interesting question, Sahil. It's come from one of our participants. Is that when there are large AMCs,
Hmm.
just recently as yesterday, Nippon AMC have restricted inflows into small cap.
Hmm.
Why are we still taking money in small cap, and why should people look at us?
So, I mean, I'm just going by a very, very simple metric of growth versus valuation. If the valuations would have been at 27, 30, 35 odd times, then obviously we would have not suggested to enter small caps or increase the allocation to small caps now. The other point is the size of the AUM. So we are at around 2,000 crore, which is a reasonably sized AUM. But when we do a liquidity analysis of our portfolio, almost 85% of our portfolio can be liquidated in less than 5 days. Now, this is a very hypothetical situation that we'll get 100% redemption. But even if this were to be the case, we can easily liquidate stocks in less than 5 days. Now, when we calculate this, we don't say that we are participating in 100% of the volumes. When we calculate this, we say that we'll participate in only 20% of the volumes, which is a logical number to put in. So after doing this, I think, and obviously our focus on liquidity in the stock makes us believe that the AUM where we are and where the valuations of small cap is at, at least over next 3 to 5 years, we believe that I think there is good money to be made.
So, Sahil, you touched upon the point of liquidity. Uh, there are, possibilities, and there are cases where many competing fund houses keep some of the money in large caps, or
Hmm.
maybe some higher liquid mid caps. What is
Definitely.
your stance as far as liquidity is concerned? You explained about the fact that you look at 30%, etc. But in terms of exposure to other cap, what has been your stand?
So we are very clear that when we enter into a stock, we will not enter into a large cap company. We would be more than happy that a small cap would become a mid cap, or a mid cap would become a large cap, and we might choose to stay invested, or we might kind of want to sell it. That depends purely on the fundamentals and the opportunities that are available at that point of time. But as I said, we are very clear that we never enter into large caps in our small cap portfolios. So there will be mid caps, there will be small caps. There have been instances where we have entered into some of the companies over the last 2 years, which were mid caps, which have now become a large cap. But we never enter into large cap companies. And the reason is very simple, that the allocation that is done at our distributors end is something where they have already done allocation in terms of cash, real estate, large cap, mid cap, small cap. We don't want to kind of tinker with that allocation by putting large caps into a small cap fund.
Is there any minimum market cap which you look at before entering a company? And if not, what is your threshold? Is it profit? Is it some kind of a scale? What is it that you look at before entering a company? And what is it in terms of percentage allocation to the portfolio that you start with?
So, the minimum market cap that we look at is around 2,000, 2,500 odd crores. And again, market cap is all relative. So, safe to say that BSC 600 and not 500, it would be the universe for the small cap fund. In terms of the starting weight that we typically enter into, so we typically believe in buying slow. While we have done our research, while it has been debated within the team, the idea is part of the investment universe. Typically, we start with the half or 1% position, and then gradually scale it up depending on where we want to take that position to. Also, typically, as of now, there are no positions in the portfolio which are about 3.5 to 4 odd percent. So that's where we are.
So, Sahil, is there any fund size which you have in mind, given the current market dynamics, that beyond which you would not be comfortable, or you would leave that call to an investor or a distributor?
Obviously, there are examples where a larger fund sizes in small cap have done as well as smaller fund sizes. Though the liquidity profile, like what I mentioned for the Edelweiss small cap fund, is much better. But I would say that if I have to talk about our fund, uh, 5,000 crores is something, even at this market cap with this liquidity condition, can easily be achieved without or with having minimal impact on the overall liquidity or the price when we kind of buy or sell stocks.
Okay, so this is a question with regards to unlisted. What is the regulation around unlisted, or if the regulation is allows you to buy unlisted, do you buy at all?
I'm not very sure about the regulation. I think we are not allowed to buy unlisted. But so far, I think, and we will always remain in the listed space. See, given that the opportunities that are available in the small cap space, whether it is some of the emerging themes like defense, EMS, QSR companies, these are all available in the small cap space. So at least for a small cap manager, I don't think going into unlisted space would make sense. And obviously, the risk profile of an unlisted company would be very, very different as compared to a listed company where it has a track record of either 5 years, 10 years, or multiple decades.
So, Sahil, before I ask my next question, I will request participants to post their questions on the chat window. We'll be more than happy to take each and every question, especially on the small cap fund. Uh, Sahil, you just mentioned about defense. A lot of people are talking about defense opportunity. At the same time, we saw a competing fund house launched a defense fund and stopped taking flows at 1,000 crores. What exactly is the story around defense, and what kind of opportunity you see in next 5 to 10 years?
Sure. So defense, I think, so indigenization is one of the major, I would say, theme that is playing in defense. So let's say 2 to 3 years ago, the captive manufacturing that used to happen in India for the defense was around 40 to 45%. This has moved to almost 65, 70%, and this will further move up. Whatever orders have been received by these companies, and these companies are full of order books because of higher captive share that government wants. This order book will get translated into revenues over a period of time. The other thing that is also happening is that some of the developing or emerging economies around the globe are also now looking up to India in terms of as a supplier of some of the defense equipment. And the reason is that earlier we used to use whether it is missiles or fighter jets. These are all kind of imported, or the technology was imported. As we start to use our own India-made defense equipment, that gives a lot of confidence to this emerging economies to kind of outsource those. So exports as an opportunity is also opening up, and we are seeing some initial green shoots as far as exports is concerned on the defense side. So it is not only the indigenization story of defense that is playing out, but it is also that the next leg of growth can come from exports.
Sahil, the next question, is with regards to microcap index, Nifty microcap index. The question is that should we invest in Nifty microcap index or Edelweiss small cap, and if so, why? And do you have any plans to launch a microcap fund? So I'll answer the second one. We can only launch the categories that are allowed by SEBI. So SEBI in 2018 consolidated small cap and microcap into one category. So unfortunately or fortunately, we cannot launch a microcap fund, but it's a good suggestion. We can take it up to the regulator. Sahil, if you want to answer the first question.
So I think, see, microcaps, as we go down below the market cap curve, the mortality rate or the chances of company survival is on a much lesser side. So I think when a company transitions from a micro cap to a small cap or a mid cap, it takes certain years for it to do that. And in that journey, they set up their systems, people, which gives a lot of stability to the business. When a company is micro cap, it's a different ball game. It's more like a startup investing that one has to do when a company is, let's say, 200 crores, 500 crores in terms of market cap. So there, I mean, it's a highly risky game. It's a highly there to invest in a micro cap index. Again, I mean, when the going is good, one can get enormous amount of returns by investing in micro cap index as such. But I think stock selection in micro caps matters very much, even more than small caps, and even more than mid caps. And hence, I mean, my thinking is that micro cap investing is a different ball game. It requires a lot of active management as far as micro cap investing is concerned.
So, Sahil, this question is around research capabilities. The question is, how many research analysts do we have, or if you would like to answer it in a different manner, how do you handle uh, you know the research portion of analyzing companies, getting feelers? Is it uh, in-house? Is it broker-driven? So, if you could throw some light on the research process.
Sure. So I think it is all in-house driven. Our research is completely in-house driven. All the fund managers also double up as analysts, and we have a team of around 6 people. So I think most of the sectors are covered within this 6-member team. Every individual covers at least 2 major sectors. So I think in terms of bandwidth, in terms of our coverage, it is all in-house. We have our own financial models, our own projections that we do. In fact, the forensics that we do or accounting quality checks that we do, it is also not only third-party based, but it is also done in-house. So I think the capabilities are all in-house as far as the research is concerned.
I think you have answered this question, but again, I think it's a repeat question, Sahil. Many fund houses have taken a view that small caps are overheated,
Hmm.
and people should either not invest or invest in only an SIP STP manner.
Hmm.
What's your take on that? If lump sum were to be given, what could be an ideal investment horizon?
Sure. So I think if I look at last 1 year, a lot of returns that, in fact, if I just remove last 3 months till 31st of March, the 1 year returns, small caps in fact are underperforming large caps. It is in last 3 months that the rally in small caps have started. Now, going by the history, it has not happened that typically after 3 months of up move in small caps, there is a sudden big correction that happens in small cap. Now, this is, I mean, if there is a hard landing in US or if there is a big bank failure in US, which we don't know whether it will happen or not. If that happens, then obviously the markets will go down and small caps will go down as well in the short term. The other point here is that if I look at last 3 years, yes, small caps have significantly outperformed large caps, but this is after a period that followed when small caps significantly also underperformed large caps. So if I take a cumulative period of last 5 years, small caps have yet to outperform large caps. Now, why should they outperform large caps? Is because the earnings growth that we have seen is is at a faster pace as compared to the large caps. Also, going forward, typically in the scenarios where we have seen that the profit growth of small cap is faster than large caps, small caps typically tend to do better. Now, this is all kind of also supported by liquidity, not only from the net inflows that you are seeing that small caps are getting on the mutual fund side, but also from FIIs. So typically there is a belief that FIIs only invest in large caps or largish mid caps, but even in small caps, almost 9 to 10% of the shareholding is by FIIs. So now, at least over last 2-3 months, because of the valuations, a lot of the money flow from mutual fund as well as FII side is also what is driving returns over last 3 months.
Sahil, this question is, what is the total market cap of small cap universe?
So, frankly, I mean, anything that is below 250, 258th company is a small cap. So what we have defined for ourselves is around 350 companies as a universe, which is typically today about 2,500 to 3,000 crore market cap, which is part of the small cap universe.
Okay. So there's a question that a lot of people have made multi-bagger returns on individual small caps. Why not through small cap mutual funds?
I think, uh, I mean, at a stock level, even I mean, some of the stocks that we have been holding for last 2 years, 3 years, 5 years, there have been multi-bagger returns. Uh, I think if we look at a longer period of time, small caps and mid caps have delivered returns which over a period of time it will look like a multi-bagger return. But obviously, I mean, when you are investing in individual stocks or having a very concentrated portfolio of five stocks, while one can make multi-bagger returns in good times, it can in bad times it can also go the other way around. And given that mutual funds are diversified across at least more than 50, 60 stocks, uh, to make multi-bagger returns in a short period of time at a NAV level or at a fund level, it's I would say very difficult. But if one is looking at returns which are inflation adjusted on a higher side as compared to some of the other categories, then obviously small cap mutual fund makes sense.
So Sahil, this question may be very tricky, but let me still ask this, especially for a widely held small cap fund. What are your top five holdings, and what is the holding thesis or adding thesis for these companies, and how have they done when recently in terms of results?
So we have, I mean, the fact sheet would be in front of a lot of people, so they can easily see that the company, the top five companies that we hold in our portfolio is Westlife Development, KEI Industries, Canfin Homes, JB Chemicals, APL Apollo Tubes. So these are some of the top names that are there in our portfolio. As in this case of QSR, I have kind of talked about that why investing in QSR makes sense. Uh, and let's say in the case of Canfin Home, it's a company which has negligible NPAs, which is the most important thing as far as lending business is concerned. And across cycles, they have been able to kind of do extremely well over a period of time, growing the loan book by 20 odd percent. So I think that is something that we believe is what will drive value creation for this particular company. So different companies will have different theses, but I mean, if I look at the top five or top 10 companies in our portfolio, a lot of these companies have a very successful track record of last 5 years, 10 years. I mean, it's very clearly visible in the way they have grown in terms of their profits.
Thank you, Sahil. Let me also add that we don't and would never make any stock recommendation. This is only talking about top five holdings on the published fact sheet, just from a thought process of how do we look at businesses. This should not be treated as any recommendation whatsoever. So, uh, thank you everyone for giving your valuable time, asking all the relevant questions. We really appreciate your support. If you have any further questions, we'll be happy to answer all those questions. Sahil, thank you so much. We would like to end this call. Thank you.
Thank you all.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.